Hi guys, welcome to today's session. I'm going to give everybody a moment to join, and I'm going to make sure that I've shared the link everywhere that I need to share. So bear with me for 2 moments, please. Welcome guys, welcome. There's a lot of welcomes on it. There we go. How are we doing? How are we doing? Hopefully it's, let me just check the streams working. Indeedio. How's everyone's day been so far? All good? Getting ahead with Dr. Ojo. Welcome, first time joining. How are we doing? Pleasure to have you here for the first time. There's going to be plenty of sessions for you to come back to if you enjoy them, of course. We do a lot of work with strategy development around here. The main purpose of these sessions is just to see how you can make the most of Darwinex and Darwinex Zero and see how you can improve most as a trader. So it's fantastic to have you here. If you have any questions, please let me know. Just write them in the comments and I'll do my best to answer them and go over everything that you guys ask. Calistine says hello. How we doing? Hope you're all good. First time seeing your name as well. So if you're new around here, please drop any questions that you have in the chat. And again, I will be happy to go over anything that you guys have, or happy to review any of your Darwins too. If anybody has a Darwin that they want me to take a look at today, I'm more than happy to do so. Usually the Wednesday sessions that we have are primarily reserved for strategy development anyway. So please, if you have a Darwin that you want me to take a look at, just pop it in the chat, whether you're watching this on YouTube or X, and I'll be sure to take a look. Seems the markets are a little bit calmer the past couple of days, which is good. It's good to see that we're back on track, right? I can't wait to ask, how do I get to increase my Darwin risk? So I presume by this you mean your risk multiplier. Simple answer to that is just reduce your value at risk. There's a few different ways that we can do that. You can reduce the trade frequency, the trade duration, or the asset volatility that you trade. So trading less volatile assets, or simply reduce your position size, which is the one thing that I would say it might be worth doing. There's no real benefit to increasing your risk multiplier because your Darwin will always come out the same result anyway. They're like a self-balancing mechanism. So if you drop your value at risk, your risk multiplier is going to increase. And you might say, well, it's going to be more true to life to your Signal account. But if you're dropping your risk at Signal account level, the risk multiplier is going to be multiplying a smaller amount anyway. So you will always come out to the same result. My Darwin is pretty bad. DGCM. We'll take a look. And then Vito says, hi, mate. How are you? I'm all good. Thank you very much for asking. Hope you are too. Please check Puxo. What a name. Yeah, we'll take a look at Puxo as well. Let me just take a look at DGCM first, and then we'll take a look at Puxo. That's an awesome Darwin name, nice. DGCM. I think this is bad. DGCM on the right. I'm on the right one, right? April, May, June. 13.6%. I don't think that's bad at all. I'm presuming some of this is booster / permanent allocation, perhaps. Although some is Darwinia. I mean, I was expecting a lot worse. Let me tell you that now. Let's take a look at your value at risk. Okay, so you're hovering around 30%. Okay, so it's increased slightly recently. So this is a concept that I explained yesterday, right? And I'm going to do the same diagram that I drew yesterday because I think it's interesting to do this. Yes, boosters mainly. Okay, that's fair. So let me load Epic Pen. There we go. So the way I think about this chart, the risk management chart, if we draw a graph like this, okay, and we say this is the percentage of you blowing your account. Okay, so 100%, 0, and then this is your value at risk. So we might have 1, 5, 10, 20. I apologize for the text. It's difficult to do this with the mouse. Let's just go 50 plus. Okay, so this is your value at risk. So this axis is the value at risk. This axis is chance of blowing account. Okay, so 100% chance of blowing your account, 0% chance of blowing your account. Now, when we say 30% is over here, 30% value at risk, the way this goes is there's a very steady increase, but slow, a chance of blowing your account. And then as you surpass 30, that curve exponentially rises like this. Okay. So there's kind of this zone here where if you're under 30% value at risk, there's very low chance that you will ever blow your account. Not saying it's impossible. You can blow your account or go into a massive drawdown. However, if your value at risk is under 30%, you can see that you have an exponentially lower chance than anything above 30% where the chance or risk of blowing your account exponentially increases. That's what we've seen over the past 13 years of running Darwinex. 30% seems to be, I don't want to say the sweet spot, but the number where traders above it have a real high chance or high risk of blowing their accounts. Underneath, less to worry about. Now, you're sort of on that level. So I'm presuming that you're being risk adjusted by maybe 0.2x potentially. It's not necessarily a bad thing. If you wanted to lower it, I would suggest lowering your position sizing so that your value at risk comes down. But again, your Darwin is always going to come out to the same result. And to be completely honest, I don't think you've got anything to worry about. Part of me thinks this looks semi like a grid / martingale strategy, although you don't have any significant drops really in equity. So perhaps it's not, but that's how it looks at first glance. If you take a look at the win rate, you might be able to get a little bit more of an idea. 2,000 trades, that's a lot. 70% win rate, the negative risk to reward. Yeah, so I'm not saying this is grid or martingale, but it looks like it could be. Much longer losing trade duration than winning trade duration. So you're always going to be up against it when it comes to value at risk if you are grid / martingaling. Again, I'm not sure if you are. It's just me making an assumption. Yash, mine too, ZJPW. Okay, we'll try and take a look at all of these. VCA, please. Any hope? Please, can you have a look? New strategy since Jan 2025. Any hope? Let's take a quick glance. VCA. My Darwin is QCNY. Thank you for sharing. I'll see if I can get time to go through all of these. Oh, wow. So I'm presuming you traded with Darwinex years ago and then you haven't picked anything up. Or sorry, you haven't traded in a couple of years. Now you've picked back up from January 2025. Okay, interesting. My question is, why didn't you start from scratch and create a new account? Purely because this is a classic account, right? So this is through Darwinex. You could have moved your money to another account and started trading there. But anybody who's unaware, being through Darwinex, this would be live capital. So it's not through Darwinex Zero. This is actually live capital deposited in the broker. My personal suggestion, and to be fair, I would probably even say this right now. If I was you, I would think about starting a new account, getting rid of VCA, starting from fresh, because you're always going to be up against it with a max drawdown of 21%. I still think you should. I know saying, yeah, I should have. I still think it'll be worth it. And the reason I think it's worth it, you'll lose this. So you'll lose the recent booster that we brought in. So we brought in booster points or bonus points. So you get rewarded based on how long your track record is. So you can see that every month you're going to have 3 points added to your rating. However, your rating is these three factors. So you return in the current month, you return over the previous 5 months, and your max drawdown over the past 6 months. So you can see already you're up against it. Maybe it's worth starting from scratch. I don't know. It doesn't cost you anything to reset because you're trading through Classic. It's worth a thought. Okay, is my opinion. However, when we take a look at this, so if we go from 1st of January, year to date, we take a look at this from the 1st of January. It's a completely different record, right? You can even skip out from there. It's completely different trader, right? So, I mean, I guess it's kind of up to you whether you'd want to carry on and you know, maybe if you turn this round and you keep moving up, it might be worth keeping the 3 points. But me personally, I'd rather be getting rid of all of this and starting again from scratch. But that is a decision that you have to make. Like I say, the fantastic thing for you is that you're trading through Darwinex, so you could start a new account and it's not going to cost you anything. It's not going to cost you a restart fee or anything like that. This year's performance, I mean, it looks pretty solid, right? 9%, 9.7%. Ideally, get another couple of percent in before the end of the year. But hey, when we compare it to 0.0, obviously he was inactive, 2% that year and a minus 14% that year. It's clear that you've changed something or doing something different. And you know, it's worked, right? So clearly you're doing something right, which is fantastic. What does it say? VCA creation. Zoom out. Did you import this track record from a previous broker? I'm just wondering if you imported this because or had it refreshed or something, but this looks like you might have imported it from a previous broker. I'm not sure. Risk 1%, how we doing, dude? Hope you're all good. I did see your message in Discord earlier. I was on a call that ended up carrying on for like 3 hours, so I apologize I didn't get a chance to come back to you, but feel free to direct message me if you didn't get an answer. Would buy permanent allocation for Darwinex 0 start personal account with Darwinex with £1,000. Listen, it's completely down to you. The good thing about the permanent allocation is it's basically leverage. So of course you're going to have that $100,000 allocation for the rest of time. I can't advise you whether to open a broker account, deposit real capital, of course, because of regulatory reasons. So I'm going to leave that down to you to decide. The great thing about trading through the broker is, of course, you keep any profit that you make on your deposit. The issue is, well, of course, your capital is at risk, but you'll probably still earn more trading $100,000 permanent allocation and taking 15% performance fees than you would on £1,000. The only thing you have to account for is, of course, your subscription costs. I guess it's just your risk appetite. Are you happy risking your own capital, or would you feel more comfortable, trading virtually and buying the permanent allocation? The only thing I would say is don't buy the permanent allocation until you're absolutely sure, because of course, if you were to restart your account, you lose the permanent allocation. So be 100% unsure or certain on the path that you want to take. And ultimately, you could buy the permanent allocation and in future migrate the track record to Darwinex anyway and get the best of both worlds, but completely down to you. Pleasure, Anno. Pleasure. Right, let's go back up the list. Who was it? Puxo. Fantastic word or name. Puxo. Okay, so we've just had a question from Fernando. So he said your Signal account is up 70%, but up on Darwinex is too low. I mean, to be fair, I would be pretty pleased with these results. 18.59% since May, like is fantastic, especially with a 5% drawdown. You won't. So this is the issue, right? You won't get your multiplier to be increased and increase your performance at Darwinex. Your Darwin will always come out to the same result no matter what, because your risk multiplier and your value at risk are like a balancing mechanism. So if you decrease your value at risk, you will increase your risk multiplier. But if you, by decreasing your value at risk, you're trading lower position sizing. Let's say you're now taking $500 on a winner instead of $1,000 on a winner, but you've doubled your risk multiplier from 1x to 2x. Well, 1x on 1,000 is exactly the same as 2x on 500. So your Darwin will always come back at the or come out to the same result, regardless of what you do from a change in the multiplier perspective. What we have to realize here is that your Darwin is a real investment asset that is licensed through Darwinex, meaning that you can take on capital in a regulated capacity. Okay. Doesn't mean you're regulated, but the asset is regulated through Darwinex's asset management license. With that, we have a responsibility to protect investor capital, to protect the traders, and to also protect our own interest and our own capital. So what we do is we risk adjust every single trader to 6.5% value at risk, which I'm sure you're aware. But what's important to remember is that your Darwin is co-owned by Darwinex. It's our risk management, your trades. So we won't ever be able to increase the risk just because your Signal account's up 70%. I mean, also, please understand that 19% or 18.5% in what's that, 6 months is phenomenal. Like, that is a phenomenal return. So don't put yourself down thinking, oh, it's not up enough when my Signal account is up 70%. Like, that is a fantastic return. And your value at risk isn't even that high, 21%. So you're not stupidly out of scope when it comes to risk exposure. And this is a thing of beauty, by the way. This tells me that you have no problem setting a stop loss and a target and just leaving it to do its thing and not interfering with your trades. You can see at the end of each bar, there's like a little black line, and that effectively shows where you close the position relative to your MAE and your MFE. The majority of your black lines are at the tips or the bottoms of your candles, meaning that you let them run to stops and targets, which is fantastic because it shows me that you don't have any discipline issues. You don't FOMO when you're in a trade and start closing trades early or letting trades run. There's only this one trade here, this dollar Swiss trade that's, I wouldn't even call it an outlier really. I would just say that the stop is bigger than the rest. Other than that, it's pretty uniform. There's a couple over here as well, but nothing to be concerned about. But dude, I honestly can't really find a fault with this, to be fair. You've got fantastic risk-adjusted metrics. I just ask you to try and measure your expectations or manage your expectations a little bit more holistically. Understand what you've done is far above the average of any other trader, and that we have to risk adjust your strategy to be able to offer it out to investors. But do not be disheartened by this. This is fantastic. So that's all I'll say on that. We'll go back to Puxo now. I see other people are putting their Darwins in. I will try and get through all of them. I can't promise anything. We've only got, I think I've got about an hour today. Maybe we can push an hour and 10, hour and 15. But I like to give everybody the attention that they deserve. So if I don't get to go through your Darwin today and you've put it in the group, please feel free to message me. And I don't mind doing one-to-one breakdowns or doing these again. We can jump on tomorrow. Tomorrow's session, I'll do some more strategy development stuff. So if you're around tomorrow, I can also do it then as well. So don't worry if I don't get your Darwin review today. We will get it done. Just make sure you message me. Fernando said, I started to decrease my percentage on trades on my Signal account from 1% per trade to 0.7. I want to go to 0.5%, but I'm making it slowly. Fantastic. I mean, whatever's going to help you trade the best. But please remember, like, what you have at the minute is fantastic. It's far above average. So don't try and fix something. Don't get in your own head and try and fix something that's not broken, because you're already doing something that a lot of people cannot do. And I know it's hard when sometimes you get, and I get this now, get a bit of imposter syndrome, and you start to think, but what if this, what if that? And it's a little bit like you can get in your own head, but just realize that you've done something fantastic, and just let go of, like, relinquish the control, relinquish the idea of it having to be more or having to be perfect. I think you were 60th out of the 9,000 traders in silver. Like, it's already a fantastic achievement. Just relishing that. Tortuga Capital, thank you for sending your Darwin in as well. Appreciate that. I'll see if I can get through to it today. But again, it'll be easier for you because you're watching this on X. If I don't get through to it today, please just drop us a DM on X, and we can either do it tomorrow or we can do it in private. That goes for everybody else who's sent their Darwin in as well. Getting ahead with Dr. Ojo, does that mean whatever it would remain the same? Only chance to make more ROI? How do you get to 3.3? Presuming you're asking because of my risk multiplier down here. So I risk really little on my account. So I'll bring up XAQP. So this is my Darwin. You can see I'm in with tiny size, 2 trades on dollar yen, 0.06. Okay, so even if I get stopped out on these, each one is $33, so $66 risk. So I don't risk a lot on my account. Therefore, I get scaled up quite aggressively too. I think my my actual account is, if you take a look at this, this is for the guys who weren't in the session yesterday. This is a journal that I've been working on and created recently. Whether I commercialize it or not, I don't know. I'm kind of building it for me and what I'd want out of a trading journal, but we'll see. This is my equity curve. I need to move that. That looks gross. Just get rid of it for now. So you can see my P&L is about $4,878, but then my Darwin is up 27%. Okay, so I'm getting scaled up quite aggressively, which also brings around its own problems, because you might have a bad day on your Signal account and you'd be like down, a small amount, but then you look at your Darwin and I'm down like 2%. So that can be quite difficult to overcome as well. But again, this is since the beginning of May, basically. So again, I'm way above the mean. I know that there's a high chance that this is going to come down at some point and surpass this drawdown, which is unfortunate, but it is what it is. Anyway, back to Puxo. Was there any other questions before we move on? No, perfect. There's just Tortuga Capital and the guys who've sent their Darwins in. Let's take a look at Puxo. Okay, so first things first, this didn't start till mid-August, so it's going to be difficult to take any real sort of insights from this, purely because there's just a lack of data at this point in time. So for context, when I'm talking about data and statistics, before I become a trader, I was a data analyst. So when I'm looking at a data set, I want as much information as possible. I want to be able to quantify things super, super easy. When we've only got 3 months of data, especially in trading, it's very, very difficult to take anything that's truly robust away from it if we're looking at patterns in data and stuff. The reason being is because that's such a condensed period of time, where macroeconomics, policies, all these sorts of things can affect it for just that period of time. The market could be in a range depending on what you're trading. The market could be trending also, so your data can get skewed. For example, you might have 6 winning months of the year on average and 6 losing months of the year. These might have been your 6 losing months. These might have been your 6 winning months. So again, we're getting rid of the true representation of your years just based on the random distribution of your results. And that will always be an issue, right? But the longer your track record, the more data we have, the easier it is to interpret things and to take sort of key insights away from it. So I just want to preface with that, because I will probably be saying, but you should test this, because I don't know for sure, because we're just not going to know for sure, right? So first things first, let's take a look at your value at risk. Vito said, what should I do to increase my performance fee calculation? Thanks in advance for your time checking my account. It's a pleasure. It's a pleasure. I'm not sure what you mean by increase your performance fee calculation. I don't know. I don't know what you mean by that. So just clarify, and again, I'll be happy to go over it. Value at risk. Okay, 27%. So slightly on the higher side, but still nothing that's of concern. Going back to the graph that I did at the beginning, you're below the 30% of the bell curve. So as soon as you, it's not a bell curve, it's an exponential curve. As soon as you surpass 30%, the risk of you blowing your account or risk of you going on a large drawdown increases exponentially. You're still below that, but just fractionally. So just be careful, just monitor your risk. I wouldn't let this increase any higher. So don't increase your risk at Signal account level. Just try and keep it as stable as possible. If anything, and you decide you want to bring it down, just lower your position size slowly over time. However, I don't think it's of concern yet. Okay, we'll go over this in a second because this is interesting. I'll go over in a minute why I hate trades like this, and I'll explain why. Okay, assets and timeframes. Let's start on my favorite thing. Let's see where you strike hard and where you don't. And again, this has to be prefaced with there's not that much data from a time perspective, although it looks like you're quite active as a trader. So I'm presuming that you're a scalper or an algo trader. So we have index futures and commodity futures. Okay, so 73% of your trades are done on commodities with a 76% win rate and 226% or 228 trades on indices with a 56% win rate. You've got a negative return or slight negative return on indices, whilst your return on commodities is, fairly sizable. Too early in the journey to say, oh, you should drop trade in indices and focus only on commodities. However, that is where I'm leaning already. You have a decent amount of trades. This is where there's a little bit of a playoff, right? You can judge a track record stability in time or the amount of trades. I personally like to have both. So even though you have a large amount of trades, I'd still like a little bit more time, because what you might find is your strategy just doesn't work on indices for this specific period of time when the market's been trending and breaking out. Maybe you're more of a mean reversion trader. I don't know. I only see the data. But I would be monitoring this over the next 3 to 6 months. And if over the next 3 to 6 months, again, let me bring up Epic Pen. I think being able to draw this stuff out really helps, because I used to just try and explain it, but I'm going to try and start being more visual now so you guys can understand where I'm going. So let's say this is where we're starting from, okay? And so far your commodity trading has gone like this, right? You've been trending up, whereas your indices, you're pretty much flat break even. Okay. Now this is where we are now. We're here. What I would be doing over the next 3 months is judging whether this is an accurate representation of your strategy, or of your strategy. And then I would be taking a look at, okay, if we put a block on there or a pause there, what happens for the next 3 months? Okay. If commodities continues to rise, yeah, it might have some downtime and then carry on going up. We go, okay, well, that's an 8 out of 10 representation of there. Okay. If this continues moving down, that's an 8 representation out of 10 over there. Very similar. Okay. That is similar to that. At what point do we go, well, we're just losing money over here because this is consistently trending down whilst this is consistently trending up? And you have to make the decision. Do you step away from trading indices, or do you make adjustments from a strategy perspective, or even from a risk perspective? Do you still trade the indices and trade a lower size, or do you just scrap all of this and focus solely on commodities, which I think is what you should potentially look at doing in the future if your data continues to trend in this direction. Now, of course, if you're over the next 3 months, let's say your indices trading has gone like that, and then all of a sudden spikes up. Well, of course, we know that this was potentially just a period of time. And if we looked at it on a bigger scale, it might have looked like that. Okay. So we're not taking this out of sample data here and making a decision yet, but we're going to kind of break it down into 3-month chunks. Okay. What does this quarter look like? Is this quarter up? Is it stagnant? Okay. Is it up? Is it stagnant? Okay. So this was just part of the larger cycle. So I'm not going to drop that asset. I'm not going to stop trading it. I'm going to give it some time, understand that there is a positive expected value over a longer period of time. You're only going to know that, with hindsight, of course, looking back. So continue trading it for the next 3 to 6 months. But again, eventually you're going to come to the point where you have to make a decision. It's clear that something's wrong, or at least something's been wrong for the past 3 months, because your win rate has a 20% differential. Okay, so I'm not even looking at the return. You're winning a lot more trades when you trade commodities as when you're trading indices. Now, of course, you can say, well, I'm trading a different strategy, or I traded with a larger risk to reward, but it's clear that that's not the case either, because you're losing money on there. So I'm presuming that you're trading the same strategy across both assets, which is fine, but also understand that not every asset moves in the same behavioral patterns as other assets. For example, indices are designed by nature to increase in value as economies grow, as more money is printed, as inflation occurs, there's more currency going through the market. These businesses' valuations therefore increase over time. And therefore, the S&P 500, the NASDAQ, the Dow Jones, and other indices also increase in time. They are designed to move up and to the right, okay? Now, if you compare that to euro dollar doesn't have the same mechanics behind the asset. It isn't designed to move up and to the right. It's designed to balance one economy against another economy. So there's a constant battle between the two. Whereas the S&P, for example, is a measure of the top 500 companies in the US, designed to go up and to the right. So you cannot just take a strategy that you have for one and implement it on another asset and be jobs are good and I'm just going to trade euro dollar the same way as I trade the S&P, because they move in completely different ways. Even different currency pairs against different currency pairs will also have their own peculiar but different sort of behavioral patterns. But the biggest one is asset class versus asset class. And some traders are just fantastic at trading one asset class, but they cannot for the life of them trade anything else. It's just about recognizing, is that you? Am I that trader who can't trade indices? Which is absolutely fine if you can trade commodities as well as you can. Vito said, I made 65% net profit in those 3 months, but my performance fee calculation is very low. I just wonder if I buy permanent allocation and boosters, how much can I make on performance fees based on today's stats? Still testing my skills in indices, trading. That's correct. Thanks. Okay. I would say potentially test your skills outside of this. This is going to be your record moving forward. So what you don't want this to really, I mean, you could do, but you don't. I wouldn't want it to be my playground, because this is going to be your CV in 6 years, in 6 months time or 5 months time, when this is open to investors, hopefully based on if you move up to DarwinIA Gold. You don't want investors to see a test account. You want them to see the best quality trading that they possibly can. So that's important to know. So potentially have another account, whether it's another Darwinex account or whether it's a demo account with IC Markets, whoever it may be. Just have another account that you can test ideas on before implement them into your live track record. Okay, so Vito, this is the same conversation that I had earlier on in the session. I think you were still in the session then, where I spoke about the fact that your Darwin is your trades plus our risk management. There's nothing that we can do to kind of boost your performance fee. The only thing that you can do is attract more AUM over time. So by scaling over time, getting more AUM through DarwinIA and then through investors when you're open to gold, which will come naturally. It's a bit of a longer term play. It's something that you need to work on for a few months and it will scale. Then of course your performance fees will go scale with that also. And please remember, 65% in 3 months is a massive amount. You don't have to make that much. So just focus on these numbers, your risk adjusted returns, because that is what you're going to be getting paid off of as your AUM comes in. This is, again, what we can take investment into. Again, we're only licensed to do so when our risk management is enforced. So that's super, super important to understand. Getting ahead with Dr. Ojo, you can't see somebody's risk multiplier. You can see their value at risk, so you can kind of get a gauge where they are, but you won't be able to see this. You can only see mine because I'm logged in and I have it there. But you won't be able to see somebody else's. Trading time distribution. I'm not a fan of this statistic anymore. I explained it in yesterday's session, but ultimately you can't decipher here whether you were opening or closing a trade within these times. So as far as data goes for this, it's pretty naff, to be honest, because you can't make a decision of am I entering or exiting in the wrong session or wrong time, because it's quite generalized. Return distribution by day of the week. You haven't got enough data on this. I tend to just look for outliers here. So you can see there's quite a big differential from your worst day, which is Wednesday, to your best day, which is a Friday. Pardon me. There's about 7%, maybe just over 7% difference. But to me, you just don't have enough days, because again, if I bring my pen up, or two bad days on a Friday can bring this down. And then maybe one or two good days on a Wednesday can bring this up. And then we've closed that gap massively. So again, this is just something that I would want to understand over the next few months. Is this pattern continuing? Because if this happens, if all of these lines keep moving up, which believe me, happens, and I see it a lot, all these move up and then this one day keeps moving down, we need to highlight why this is so different. And quite often it's nothing to do with strategy, but sometimes it's to do with your routine. So your routine and your behavior as a trader can affect your performance. For example, the examples I always give for this, and I won't go into too much detail because I do every week. The two that stick in my mind for this was I worked with a female trader last year through Darwinex. We looked at this. Her Wednesday was always her underperforming day. And we found out that this was due to her rushing her way out the door when she was taking her daughter to school. So she'd be taking her daughter to school. She'd rush her trades on a Wednesday, and therefore her performance was like this. It was an outlier, moving down into the right. Whereas all of her other days, where she was bound by the same routine, working from her desk, she was had a pretty positive expectancy across the board. The other example was this day was a Friday, and all the other days. This was for a guy I worked with again through Darwinex. Tail, you sweet talker. Who's this handsome fella on my screen? Tail says, how's XAQP doing? We'll get into XAQP in a moment. I worked with a chap on trying to improve his strategy, and his Friday was just moving lower and lower. And basically what we found out was he worked on a building site, and in the UK, usually builders finish work early on a Friday. And what he was doing is he was taking his phone to the pub, having a few beers, and then he was taking trades on Friday afternoon, and it was massively affecting his performance and his expectancy on a Friday. So those are all things that are non-strategy specific, but it's important to be aware of, because you might look at this and think, well, what am I doing wrong on a Wednesday? But it's important to look outside of the charts. Your charts are just one variable. Your macro analysis is one variable. All of these different things are just different variables, and you have to try and figure out the variable that's not quite fitting in the plan for that specific data set. So here it could be anything. It could be something to do with your routine, your lifestyle. It could still be your strategy. Who knows? But only you will be able to find that answer out. XAQP, Tail, you ask, had a little bit of a recovery today. Nothing major. I'm in a couple of dollar-yen positions. In a couple of dollar-yen positions at the moment. So we're just hovering about up here. Let's move on. Strategy analysis. 870 trades. That's a lot in 3 months. How many is that on average? I always bring my calculator up, forgetting there's a daily trade frequency here. It's 18 trades a day. That's huge. I'm presuming that you scale into some positions and you add to the same trade as opposed to being 18 unique trades each day, because that would be a hell of a lot. So I'm presuming that, let's say you're long on the NASDAQ or long on the NQ, you're entering that multiple times potentially. Simon Newman just joined this afternoon, mate. Well, appreciate having you here, and welcome to the Darwinex family. I apologize if you can hear my dog growling. She's at the bottom of the stairs watching out the window, so I'm not sure if you can hear that, but I can. Tail says, I had a dream about XAQP. Funny you say that, because I did last night also. I also had a dream about XAQP. This is my baby. This is my, just my absolute baby. What I don't understand at the moment, though, is I seem to be getting punished from a leaderboard perspective. Like the most weighted factor in the rating calculator is your return over the previous 5 months. My return is huge over the previous 5 months, and I'm still 120 something. Like it doesn't make sense to me. So if take a look at DarwinIA. Let's take a look at just somebody here. I guess they're slightly better because their current month's return and drawdown's better. Oh my life, 27% return in October already. I'll tell you what this is. This is just this is just people absolutely caking it recently on gold and silver. I bet they trade gold indices. Okay, no, there we go. Indices 5%, commodities 23%, gold. Yeah. So if we take a look at their positive excursion, well, would you look at that? Gold. Massive trade on gold. So I'm presuming they've just gone long on gold. I think there's a lot of people who are probably doing something similar. Not to take away from anything that they've done, but I mean, look at that. Super fairly low numbers, and this is absolutely fine, by the way. There's a lot of people who make a return like this. When we look at the yearly return, it's 31%, phenomenal. But the majority of that comes from 1 month's performance. Now, it is well known across many traders that I know that you do make the majority of your return in a small few number of trades, but that's kind of an extreme example. Yeah, risk 1%. You've hit the nail on the head there, dude. A lot of rankings got helped by gold in the past few months. Yeah, I mean, it's kind of annoying, right? And maybe it's something that I can feed back to Javi and the operations department, see if it's something that we can improve on. Obviously, we've included the DarwinIA bonus for the bonus of how long your track record is, but maybe there's something else that we can include to be, if your return is super concentrated in 1 month, should you be rewarded over somebody who, like, if we take a look at, you know, my performance as an example, although there is much there's a lot of better examples out there who are super consistent, 2%, 3% per month. You know, every month, let's say you've had 9 months of 2% a month, you haven't had a red month. Is it fair to penalize that trader who's been super consistent and give a higher allocation and a higher rating to somebody who hasn't been consistent over the past 9 months, but then hits it big with one big trade or one big month? Maybe that's something I'll go back and feed back to the team, because I think that's quite important too. Is we're of course trying to encourage traders to build their track record long term, right? And we want to reward consistency, consistent behavior, consistent results, and all of that sort of stuff. So I'm kind of getting my own head working here, but this is something I'm going to go back and speak to the team about. Tal says I'm 118th with 4.17% this month. Absolutely fantastic. Yeah, everybody's been doing really good this month. Like I had before, they changed the index to XAQP. I wish I had the indexes AUM in XAQP. Simon said, "Sorry, mate, been with Darwin since April, doing okay." Oh, perfect. I'm presuming that you meant joining the session. But fantastic. Great to have you here, nevertheless. Tail, I'm not touching gold again. Been burnt before. Silver is my baby. Yeah, silver was my baby until the LPs were piddling about the other day. I'm not sure if I told you this. So again, you see this big dump here. So this is XAQP. This is my Signal account. So this massive dump here, or at least the first half of it, was due to an error by the liquidity providers. Now, when we look at XAQP on my Darwin, we don't have that. We only have the second half of the dump, which were actual trades. So basically, the liquidity providers glitched and messed up and executed or shown to have executed positions on my account which weren't supposed to be executed on. But my Darwin doesn't have that because, of course, it wasn't an actual trade. I don't even know how it happened. The issue is it still shows on my MetaTrader, which is super frustrating, because now my MetaTrader's in a bigger drawdown than this drawdown over here or any of these drawdowns. So it's super frustrating. I've just got to try and keep my head in the swivel because at least my Darwin is unaffected. But that's because of silver. So I can't say for sure, but in fact, I'll leave that over in case we need it. The vibe I was getting is that the LPs are nervous with silver being at all-time highs, is the vibe I was getting. And therefore their systems break and glitch, if you believe it. 124th, we're almost neighbors, lol, 118 here. Yeah, I'm coming for 118. I'm coming for that spot. Simon, MAUT is my trader index in silver, not gone with permanent allocation yet. I mean, not everybody does. I don't have permanent allocation. I also don't have boosters. But I'm committed to the long game. I'm waiting for investors. That's my goal. You know, we've always been agnostic as a company, like with permanent allocation and boosters and the products that we release. Yes, it's great because it shows that traders are committed. But also our end goal for our traders is to get them into the index. So really the permanent allocation doesn't really benefit us as a business. I think on the permanent allocation, we have literally zero margin. There's not even like a positive percentage margin on it. If anything, we lose money over time. Whereas the boosters, we make like a tiny margin. So we're profitable by selling boosters, but marginally. And this is me being completely honest. But the goal for those is to give traders the ability to earn more money whilst we're getting them to the long-term goal. So we have a vested interest in our traders being backed by the hedge fund, the index. To get there, we understand that some traders, want different things along the way. They want a little bit of a boost. They want more capital. Hence why we release the permanent allocations and the boosters. It's not for us to make more money. It's not for us to, make more money out of our traders. It's to keep our traders motivated and give them something to work on in the meantime until they get to that end goal. If you're like me and the end goal is already in your mind and you're not bothered about the intraday P&L or the intraday sort of performance fees, then fantastic. It might not even be for you. Focus on the long term. Clive, I'm having a shocking 2 months. I refuse to believe that, dude. I can't remember what your Darwin is. Sure, I've got it on watch somewhere. Nah, Clive, you're gonna have to give it me. I've completely forgot. Jason Barr, currently a great consistent performer, will never be top of the leaderboard. Yeah, this is the problem, right? Is again going back to me. I'm not trying to make it all about me, but the highest I reached at the end of the month was 8th. I actually got to number 3, but the person in front of me when I was it Oog? Oh god, this is testing my memory now. No, it wasn't Oog. Who was it? We can see in the leaderboard, can't we? Past editions. Yeah, so here's XAQP number 8. Ubu, not Oog. So just typically the 1 month that I get to kind of the top 3, and then this dude makes this massive trade, right? And it's like, it's so frustrating because you kind of don't want to take anything away from this trader because clearly they have a strategy where they wait and then they strike while the iron's hot. But on the other hand, is it fair to like penalize other traders who are more consistent when this one trader has a massive trade, like a massive singular trade? So it's there's a lot of luck involved, from not just your own performance, but how others are performing around you at the same time, if that makes sense. So you kind of have to not only be performing well yourself, but also hope that other people aren't around you who are doing this sort of thing, right? Because that's just typical. Gone from a 0.18% return to the next day and 18.7% return. I know how this person trades. They trade gaps on stocks, I think. Yeah, so that they trade stocks and they trade like opening gaps. Hence why it's they're so patient and they get these giant moves. But it's just look at the draw, right? It's there's nothing you can really do about it. It's just frustrating because I was 8th last month. And this person was 1st. Now they're 293rd, and I'm not that far down. So it's like who's more consistent, you know what I mean? Which I think is what we should aim towards, rewarding more. Risk 1%, Forex only for me, been burnt too much with indices and commodities. Yeah, feel that, dude. Yash said, honestly, time is the actual money here. Allocations can be good though. Yeah, I mean, I'm presuming you mean like time, the length of your record is the actual kind of commodity, which I completely agree with. I think if you think about every day you build your record, it's like building towards your future, right? You kind of got to see it as, and this is how I've been seeing it. It's like a delayed a delayed payment. So if you build your record for a year, you might not make anything. You might make something along the way, but let's just say you don't make anything. You're 13 months into it, so your first month after a year, you might get some huge investor come in, slap $1 million into your account, and then you make 10 grand in your next month. Again, very extreme examples, but it's a very like it's an exponential growth career, right? It's not something that you're gonna from day one be earning consistently from this, from the get-go. It takes time, but then when you get that time under your belt, the growth can be exponential, and you can go from making nothing to thousands and thousands a month in a short space of time, only after you've got time on your side. Fernando said, I'm thinking to buy a 20% target permanent allocation. I mean, completely up to you, dude. Thinking about the long term. Yeah, I mean, if you're going to buy a 20% permanent allocation, my advice would be wait till you're in a bit of a drawdown. When you're feeling like things, when you're feeling like down and you're like, oh my God, my record's in the bin, blah, 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 blah. That's the perfect time to buy your permanent allocation, especially if you're going for 20%, because by the time you get back to break even, you're probably knocked 5 to 10% off of the target for the permanent allocation. So that's my bit of advice on that. Simon Newman, trading gold and GDAXI long term here as well. Also looking for investors. Are you in gold, Simon? Clive Dean, IBVI. Of course it is IBVI. There you go. We can see you're in there. I don't know why I don't have you. I would have thought I had you bookmark. Clive. Uh-oh, the website broke. Oh no, here we go. Oh, come on, dude. I was expecting something awful. This is you're in a period of stagnation, which is fine, but that's not this. I was expecting something dramatically worse than this. Anna said, hi again. You mentioned another session soon. Any chance of getting a detailed review of my metrics VCA from 2025, please? New strategy. That would be great. Thanks for what you did already. What you already mentioned. Yeah. So I'll be streaming again tomorrow at 4 p.m. UK time. So the same time as today. So if you want me to take a look at it, then just make sure you're on the session and we can go over VCA first. That's absolutely fine. Risk 1% said, how do you work out your Darwin max allocation capacity? So I don't know the technical details on the back end, however, as in how we do it. All I know is the process. So we measure your toxicity flow that goes through the broker. Okay, so basically, in layman's terms, how easy is it to get your orders filled? So, for example, if you're trading euro dollar during the London Open or through New York Open, odds are it's going to be pretty liquid. The volume going through the market, it's going to be easier to get your order filled. Whereas if you're trading, NASDAQ spot at 1 a.m. in the morning through the Asian session, it's going to be very, very difficult to fill your orders at the right price. Spread's going to be wider. There might be a bit more slippage. There's just not enough volume. So we do that. We measure your toxicity flow of the orders. And then we measure the divergence that an investor would get based on how much capital they had invested into your strategy. We then work out at what point the investor would experience that slippage. And then we work out your max capacity from that. I hope I haven't. I had like a glitch moment there where I was like, have I made sense or have I not? I'm not 100% sure if I've made complete sense with that, but it kind of goes toxicity flow, slippage / like spread deviation, then into your max capacity. Then what we do is we shut your Darwin off when you hit the max capacity, because of course what we don't want to be doing is advertising your Darwin saying it does 30-40% a year. But then because your investor slaps in 10 million and they're getting slipped on every trade and they're only making 5% per year, of course that's our asset management license that goes on the line there. So it's super important for us to make sure that we cap Darwin's their alpha cap so that investors aren't getting shafted. Clive Dean was up 17% for the year, now down to 9%. No, you're not. You're up 16.3. Unless you're talking about your your Signal account? Or do you mean your return for the past 6 months? Because as I see it, it's 16.5% for the year, which is actually your best year to date. So I think you're doing a fantastic job. Vito said, sorry, my last question. If I made 65%, but in Darwin that represents 16%, what shall I do? What shall I do? Other significant one is dropping indices trading, changes in trading to increase my Darwin performance. Okay, so see you later, Simon. I hope you have a great rest of your week, dude. So your value at risk is measured by a few different metrics. So the volatility, the assets that you trade, the frequency of your trading, and how long you hold the trades for, and of course your position sizing. I would never touch the first three. I would only ever start changing your position sizing if you were trying to change your value at risk. I would never specifically mess with your strategy. Only ever mess with your position sizing. But again, even then, I don't think it's necessary for you to change, to be completely honest with you. OOBU is crazy. Yeah, I mean, it is, and it's just unfortunate that I was at the top of the leaderboard at the same time, because you're never going to compete with somebody like that who makes a return like that in 1 month. Jason Ball, did you pick the winners from the Edgewonk strategy stream yet? I have. I just haven't had a chance to announce them. So for the guys who missed yesterday's session, just as a quick update, I'm not sure if you've seen, but Ignacio left the company last week. So I was over in Madrid last week. Before that, I was suffering with costochondritis. So things have just been kind of like piling up. But I do have the winners. I just need to announce them on X, and then we're going to kind of re-announce them on a stream. So please just be a little bit more patient, and I'll try and get them posted by the end of this week. But I appreciate you for reminding me, because I actually completely forgot about that today. It's on my task list though. Clive said, okay, cool, cheers. Vito, okay, thanks. Yeah, I mean, Clive, you need to give yourself some props, man. Like this is solid performance, and you've hit the 300K investment mark, which is fantastic too. So just keep going, dude. Keep going. This is great. Okay, so we're coming to the close of the hour now, and I have got to go today. However, I'm going to be back tomorrow at 4 p.m. UK time. So if you still want your Darwin to be analyzed, and I haven't had a chance to do it today, please either drop me a direct message, and I'm happy to do it on a one-to-one basis, or I can send you a video of me recording an analysis on your Darwin. Or just rock up to the session tomorrow, same time as the session today, and I'll do it live. Okay. I appreciate, like, sometimes I get carried away with some of the things that I'm talking about. I end up spending 10 minutes talking about one topic. And I appreciate that sometimes people waiting in the audience for me to review their Darwin. However, if you want your Darwin analyzed, I will always get it done if you just keep reminding me. So guys, I'm going to love and leave you. Because I need to bounce. I'm going to be back 4 p.m. UK time tomorrow. In the meantime, if you need your Darwin analyzed on a one-to-one basis, please just drop me a direct message, and I'll be sure to get it done for you. So have a fantastic rest of your morning, afternoon, or evening, wherever you are in the world, and I will see you in the next session. Peace out, Clive. Peace out, everybody else. See you all later.